Today we're starting an exciting new series all about covered call ETFs. If you've ever wondered how to generate consistent high income with your portfolio, this series might be for you. And to top things off, we're actually going to start a case study in my own portfolio. I will build a covered call ETF portfolio from scratch and we'll examine this strategy. We'll explore various topics, including various covered call ETFs, the pros and cons of the strategy, and we'll see how much income we can actually generate using this strategy. So grab a Tim Hortons or your favorite Canadian coffee and let's get started. If you are new to my channel, my name is Darren and I started this channel to help out beginners because 19 months ago, that was me. And in that time, I have built a portfolio that is worth $320,000. And I didn't do anything special. What can you expect in these videos? In the first part of the video, we jump right into my portfolio where we examine the performance of it. We go through my TFSA because that is the main focus of the channel, is me building that from zero to maxing it out. And then we buy some stocks within that portfolio. So let's get into it. All right, so my entire Wealthsimple account is sitting at $165,818. It's comprised of my cash account, my TFSA, my RRSP, and the kids' RESP. And yes, Wealthsimple is my main broker for one main reason. It's very simple to use. I just did a tutorial on it if you want to check out more about it. Now, I just introduced this new RRSP into this particular portfolio, and it is a spousal RRSP. So I make the contribution, my wife actually takes the money out later in life. Sitting in the cash account, we have $20,058. This earns 3.75% interest on a monthly basis. Last month, we earned $58.73. Why do you need to have money like this? You need to have an emergency fund. So take care of your debt and get an emergency fund set up before you start investing. The kids' RESP is sitting at $78,138. And by the time they graduate, they should have about $383,000 in order to use for their schooling. And this account is growing quite nicely. Here is the asset allocation. An asset allocation is very important if you're starting off with investing. And I did some videos on that, so check out my playlist for that. All right, let's look at the performance of this account over time. We've made $61,000 in net deposits, and that is matched by the government as well. The returns are $16,000, and then simple return in a percentage is 26.89% since inception 19 months ago. When we look back, we can see in the activity tracker what's gone on over the last little while. So we had a whole bunch of government grants because they get paid at the end of the month. We also made our regular contributions into the account, which is $100 for each kid because I have 2 kids, and we do that twice a month, pardon me. So bi-weekly we put $200 in. Now this account is managed, so we do pay a small fee for it. All right, moving into my RRSP, it's up to $19,743. Over the last day, it's up $1.89. Over the last week, it's up $179. Over the last month, it's up $1,269. Over the last 3 months, it's up $2,183. Over the last year, it's up $4,383. And all-time returns on this account right now, $4,545. Now, I don't make any contributions to this account right now. This was set up a long time ago, moved into Wealthsimple. It's set up on DRIP. I have an asset allocation in here, and you can see some of the stocks that are sitting in this portfolio right now. And as they generate dividends, they then are reinvested right back in because I have DRIP set up for automatic reinvestment. And I have sort of paired some of these accounts that I'm not adding anything into over the last little while. All right, jumping into my TFSA, we're sitting at $47,028. Over the last day, we are up $135. Over the last week, we're up $551. Over the last month, we're up $1,950. Over the last 3 months, up $3,994. Over the last year, we're up $7,413, and all-time return $7,971. This is the primary account I'm putting all the money into right now every 2 weeks. We have stock lending turned on. You can see we only have 12 cents, but we're going to drop some money in there. I do $1,000 every 2 weeks. So stock lending, here are the stocks on loan: CNR, Plaza Riot, and REI. The next payout's December the 13th. And we've only made $3.02 with this. Not too sure if it's a gimmick, but I guess time will tell. And it's also money in my pocket. All right, so like I said, every 2 weeks we deposit $1,000 in this account. It's very simple with Wealthsimple, and it takes only a minute. You have your account linked, so we're gonna drop that money in and we're gonna get investing. Now, to do the investing, we are using Passiv. Passiv is the tool that I use. It helps both with my asset allocation, tracking my dividends, all the activity in the accounts, but it brings all of the accounts together. If you remember in the beginning of the video, I told you that my account is over $320,000. And you're wondering, based on the numbers I showed you, where all those other accounts are. Well, my wife has part of that portfolio, and I do a monthly series on that, and I'm up to episode number 7. So go in the playlist if you want to check out the entire portfolio. All right, so the $1,000 is dropped in there. Let's jump over to Passiv and get it to give us a hand to figure out what we're going to buy based on our asset allocation. All right, so we're in Passiv looking at our asset allocation. We're at 93% accuracy with $1,000.12 sitting in there ready to spend, and we have $48,082 in the entire account now. Now, Passiv takes that amount, figures out what we should buy, makes recommendations. So the first thing we're going to buy is 1 share of REI. We're going to buy 3 shares of VFV. We're going to buy 2 shares of VRE. We're going to buy 5 shares of XEC. We're going to buy 3 shares of XEF. We're going to buy 4 shares of XEI. And we're going to buy 2 shares of XIC. All right, now I will save you the hassle. I'll go ahead and I'll buy these stocks, and we'll jump right back into things and start off with our case study in the RRSP. All right, so we're in Passiv. We're going to look at the performance of my TFSA over the last month. That's the month of November. So we made net contributions into this account of $2,300. We can see the net change in the account over that time was $3,951 with a rate of return of 3.67%. And the investment growth over that time is $1,651. Here's the dividend history for simply in the month of November. It averaged out to $21. And of course, we don't pay any fees or commissions because we're using Wealthsimple, a great platform for beginner investors. And you can see here in the dividends, HYLD was our top performer as far as dividends, followed by VRE, REI, and Plaza REIT. Now we're going to jump over and look at the overall performance since the inception of this account, going all the way back to April of 2023, about 19 months ago. So I have net contributions of $44,803. My intention is to max this account out. And I actually just did a video on TFSA if you want to learn more about it. The net change in the account, $48,133. The rate of return, 19.23% over that time, with an investment growth of $3,330. Here's a nice dividend history. We're averaging $50 a month. So not a lot of dividends, but definitely some growth in each of the securities. Total dividends earned in the account over that time, $1,022. And you can see here, XEI, our high yield dividend fund, is the one that's produced the most dividends to date. All right, let's cover the basics of covered call ETFs. Essentially, a covered call ETF is a hands-off way to earn income from a covered call strategy, making them a great choice for investors who value simplicity and cash flow. But like any investing strategy, there are definitely pros and cons, and we'll go over those in this video series. Now, why are covered call ETFs so popular with investors? Well, like many investors, they're looking for some sort of high cash flow, especially those people in retirement. Covered call ETFs are very attractive because they offer high yields, often in the range of 6 to 10% annually. But of late, there are actually funds out there offering higher than 50% yields, and we'll cover some of those as well in this series. And I said that there are retirees that are out there who are often interested in these, but lately there are quite a number of people who are just generally interested in income, and this would be a great strategy for that. Managing covered call options on your own can actually be very complex and time consuming. Covered call ETFs provide you an all-in-one, letting you enjoy the benefits of the ETF without all the hassle. And the beauty of it is you can actually diversify yourself into various sectors, which is something that investors should be looking for, such as financials, energies, utilities. All right, now let's jump into my portfolio where we're going to build up this portfolio, and it's going to be in my RRSP. So some time ago, Wealthsimple sent me an email offering to invite me into this spousal RRSP. A spousal RRSP is where I make the contribution to the account and then my wife takes this money later out in life, presumably at a lower tax bracket. So it's a great way to share your income if you're the higher earner in your family. It just so happens that that's the case here, so we're splitting some of this income to benefit from that down the road. So I took advantage of this, I set the account up, and initially I wasn't too sure what I was going to do with it, and then I thought, you know what, this would be a great account to start a covered call ETF portfolio in, so we can track simply its performance all by itself. All right, so setting the account up was super simple. It only took 5 minutes and the account was open. And of course, then you can link your account. And if you need to know more about that, check the video up on the screen here where I talk about Wealthsimple and it's why I think it's great for beginners. Of course, there are lots of choices out there. You need to decide which one works best for you. But in my mind, this one actually is the best for beginners when you're starting out, and even for people that are just looking to be very simplistic in their investing. All right, so the account was opened, and the first thing I did was deposited some money into it. And then I had to go about establishing my asset allocation, and I used Passiv in order to do that. So the account's holding $389.11. Over the last day, it's up $1.43. Over the last week, it's up $2.63. And over the last month, it's up $4.11. And of course, it's only been open for a short period of time, so that will be the all-time performance for now. There's $87.81 sitting in the account, and you can see that it says there's $5 sitting there that can't be used. That's because there is a few days delay in moving the money from my primary bank account over into this account. Now, what I've decided for now is that all I'm going to be doing is putting $5 a day in. I want to simulate something simple for someone who's new. Let's say you're really young and you're just starting out. It's easy to do this. All you got to do is put $5 a day in and pretend that money doesn't exist. And believe me, if you're 20 years old, grab a compound calculator and just see what that money would look like when you're getting to retirement, say 40 years down the road or even 30 years down the road. So we're going to put $5 a day in and we're just going to slowly build up this portfolio. So the two funds that I've chosen right now are HYLD and EQCL, and I'll talk about each of the funds throughout this process and what they're all about. All right, so the accuracy using Passiv is 76%. There is $87 sitting in here that's investable. And like I said, Passiv knows what to do. So it's suggesting we buy 2 shares of EQCL and we buy 2 shares of HYLD. Now, what I did when I set this asset allocation up, because there's only 2 funds in it right now, is I just went 50-50%. Now, I'm probably going to change this a little bit because I want my asset allocation to sort of reflect what I have in my TFSA and my other accounts. I just haven't sat down to formalize that just yet. So for now, we're going to do 50% in each of them, and then we'll change that over time. All right, so let's talk about the first fund in the portfolio, which is HYLD. This is a Hamilton product. So right now we are in Google, and this is an easy way for you to search and look at the performance of a particular fund. In this case, it's showing red, which means that it's not a very strong performer. But the thing that I noticed is year to date is there actually is some increase in the value of the shares. And in my view, that's a good thing to see, because some covered calls, as they pay their dividend, then the net asset value or the price of the stock actually continues to drop. And in this case, there is some appreciation in this. So that's a positive thing to see. Now, if we flip over and we compare this against its another fund, which is VFV, which tracks the S&P 500, so that's the red line on your screen. We can see the blue line being HYLD, that they're kind of a mirror image of each other. Of course, we can see that VFV is performed stronger, but We can also know that we don't get the same monthly income from VFV that we would from HYLD. So again, that's part of this case study. We want to see how this performs over time against this index and say other ones and my general portfolio. All right, so we're on Hamilton's website, and the idea here is that I want to learn about the fund itself. Now, some of you may be watching my videos and thinking, well, I'll just do what Darren does. I can assure you that that is definitely not the right strategy to follow. When I share my videos, I'm sharing, my personal experience. I'm in no way a person that knows this stuff very well. I'm very much a beginner, but I would recommend that you know what you're investing in, and this is where you can start to learn about it. So the highlights of this fund: it yields 12% with monthly distributions. It's a portfolio of US equity covered call ETFs with the overall sector mix broadly similar to the S&P 500. Now, there is an American version of this, that's HYLD.U, and if you look at my monthly series, you'll see where I hold those and how much of it that I hold, because I do hold it. Who's it good for? Well, it's attractive for many investors because, like we talked about, covered call ETFs provide a monthly income. So if that's something you need, this is the fund for you. It's diversified in blue chip stocks with US equity exposure, and a higher yielding alternative to the S&P 500, which I showed you in the comparison on the Google Sheet. It also has enhanced yield and growth potential by adding a modest 25% leverage in its covered call strategy. Now, it seeks to provide attractive monthly income and long-term capital appreciation from a diversified multi-sector portfolio of primarily covered call ETFs. So let's examine that a little bit further. We can see here in the sector allocation that we have technology at the top, healthcare, consumer discretionary, financials, communications, industrials, and so on and so forth. So very diversified as far as it goes when it comes to what it's investing in. Now, what it's invested in are other funds. So this is a fund that invests in funds. Again, it saves you the work. You put your money into HYLD, and then they invest it back into these other ones. So you have SMAX, QMAX, FMAX, LMAX, AMAX, EMAX, RMAX, HBIL, and HBND. Of course, this trades under the ticker HYLD. It's on the Toronto Stock Exchange. Its inception date was February the 4th of 2022, so it's not that old, but like I said, there is some appreciation in the price, which is nice to see. The total net asset value under evaluation is $749 million. Again, the yield is annualized over 12 months, and it's at 12% with monthly distributions. It doesn't have a management fee. And why is that? Because it invests in all the other ETFs. So if you invest in this fund, the management fee is likely going to come out of those other funds. And of course, all of these funds are going to generate us some monthly income, so it'll be really curious to see how much we generate. But if you're brand new and you don't have a broker, you should probably watch this video right here.